today. As Haley said, we've got a kind of a long and complicated title for this webinar, Optimizing for Telecom Network Deployment Services Opportunities. It's a mouthful of words, but really boils down to three major categories that we want to dig into and investigate, drawing on our research and our experience supporting client projects here at TBR. First is the overall outlook for deployments both in North America and the U.S. As a focus market, but broadly speaking globally, what does the opportunity look like for telecom deployment this year and beyond? What are the challenges and hurdles that vendors are facing as they seek to capitalize on that deployment outlook and opportunity? And then what are our recommendations on how to address those challenges and how to pivot and position for success given those market dynamics? So as said, my name is Brian Belanger. I'm the Senior Director of Tailored Services here at TBR. In that capacity, I lead our custom research division, supporting our teams across our content practice areas, including telecom and telecom infrastructure services. We've had the opportunity as a tailored services team to go really, really deep on telecom deployment related research really in the past several years, but particularly in the last year and a half or so as trends in the market dictated the need for competitive market research in areas like pricing, resourcing strategy, delivery execution, market opportunity modeling, and so forth around the areas we'll be talking about today. So I wanted to draw from that experience supporting those projects to share some of what we've learned. So first, as I mentioned, our first objective is to look at overall market opportunity around telecom infrastructure services, which is a broad category of all services related to operators deploying networks that we cover at TBR, and then looking at deployment related services specifically. So this comes from our telecom infrastructure services research. Within that practice area at TBR, we do vendor revenue and margin modeling. We do market opportunity forecasting, both at a North America and global level, and talk about vendor strategies, market opportunity, trends, disruptors across that category. So just going to give you a really quick snippet here to support my conversation, but do suggest you go deeper into that research. So where's the market at? The market grew just under 3% in 2022. Speaking of North America specifically, the overall market for telecom infrastructure services, growth driven by the factors that we know: 5G rollouts, investments in network by the hyperscaler clouds like AWS and Azure, edge compute buildouts, and digital transformation overhauls. Government funding supporting a lot of the build-out activity. There's greenfield network builds going on like with Dish. While in this year, we see a downturn in overall market size growth, or decline rather, for 2024. We expect a rebound in elevation compared to historical figures. A large part of that will be government funding, such as the BEAD program and other levers that are driving opportunity in the market. And so we'll get into all that specifically. And as I mentioned, while that graph, that outlook view looks at telecom infrastructure services overall, which would include the end-to-end stack of services from engineering, design, deployment, as we're focusing on today, and also maintenance and managed services. We are focused pretty specifically on deployment for this conversation. And there is significant opportunity, but significant challenges in the realm of deployment, particularly as we'll focus on in this conversation, wired or fiber network deployments. Those four challenges, what we call our mega challenges, are wage and benefits inflation, labor shortages, capturing government incentives, and differentiating. So I think no surprise to anybody what the inflation rate and the cost of living adjustment were for in the U.S. Broadly speaking in 2022. That impacted all sectors. That, of course, equipment installers and related labor to deploy telecom networks are part of that equation as well. Companies need to figure out a way to pass those costs on in deployments, and we'll get into that in detail. Absorb those costs, while still maintaining margins through efficiencies in delivery or other methods. And so there's a pure cost factor. Couple that with labor shortages in the market. So the U.S. Government Accountability Office did a study that estimates the need for deployment in the U.S., particularly rural broadband rollouts, will require over 20,000 additional workers. There's other pieces out there from industry associations and relevant communities that support this and say there's going to be a shortage of qualified labor, multiple factors driving this, including turnover in the workforce, aging of the workforce for qualified labor, enrollments in education and related program and training programs to support those jobs. So supporting rising costs, having challenges on supply, but there's a lot of opportunity out there to be captured. I mentioned the BEAD funding. There's over that same study that the GAO did noted that there's over $75 billion in available funding over the decade or so life cycle that they looked at as part of their research that prioritizes fiber in rural areas as a build-out methodology or network structure. Navigating, capturing these incentives is a challenge and an opportunity for all vendors across the value stream, that from the operators that are seeking to win those contracts to the network builders of all types that are going to support them. And that goes to the last point here, which is while all these vendors and the ecosystem that consists of major tier one EPCs, major OEMs, and then a large number of small subcontractors, how do you all effectively vie for positions on these opportunities? How do you ensure labor supply? How do you compete on price and delivery efficacy to capitalize on that funding and that opportunity? So this comes from that same Government Accountability Office study. And again, I mentioned the focus of our deployment conversation today is going to be around fiber deployments. As you can see, what this chart shows is over the decade plus time horizon of the research they did, it estimates the number of additional telecom workers, field workers that are going to be needed to support or can be supported by the available government funding to support broadband deployment programs across the U.S. And as you can see, the expectation for need for, as I mentioned, they're supporting or favoring fiber deployments. So wired labor is going to outstrip wireless labor across that time period by quite a bit. And so again, to support our mega challenges conversation, and that's peaking in the next 2 to 3 years also. So it's where you're going to find that supply of labor, how are you going to bid it effectively to win projects. And it can't be underscored the importance of labor in that overall equation. There's figures out there that say that labor is 60 to 80% of the cost of deploying a fiber network. That's supported by the project research we've done for our clients as well. And so when we talk about a large fiber network rollout or wireless network rollout, but again, focusing on fiber here, so much of the commercial process, the success, the project is driven by the labor resources. And that really comes down to 4 levers. It's the resources themselves. What is the type, seniority, quantity of team members deployed on a project or deployed on specific tasks? Who's doing what in the stack of a project, meaning who's the prime contractor? Is it a tier 1 EPC, a vendor? And what is the mix of subcontracted labor that's supporting that project? Where are they located? How are they being orchestrated and project managed? And then what's the pyramid of delivery? So all the typical components of deploying technology, here deploying fiber networks, what's the mix, the type of resources that are going to be put on a project? And then it's what are the burdens, so inclusive of overhead, benefits, and load, the labor rates for those resources. It depends on, and we'll get into this kind of the labor rate, how it's used and how it's deployed, whether it's billed or not to customers, does depend. But it's the primary cost factor in building a bid for a deployment project. The next tower or pillar or lever, whatever we want to call it, is delivery efficiency. So how productive can those resources that are deployed on a project be to produce certain tasks that are associated with fiber deployment, whether you want to measure that in links, surveys, sites deployed, number of feet trench or board, number of splices completed in a unit of time, those types of the hundreds and hundreds of tasks that compose a rollout. What is the efficiency? If you're more efficient, obviously, on a task basis, they can produce more. That's a lever of competitiveness. And then lastly, what's the margin that's being applied to the project, whether it's being applied to rates and a time and materials construct, or being applied to per task or site or whatever pricing. What's the margin that is being planned and realized on these builds? So it's complex and not, and we'll get into each of these areas, but as we think about optimizing for deployment opportunity, it kind of comes down to these four pillars. How are you orchestrating resources? What resources are you orchestrating? How competitive are you on labor rates and efficiency? And then what margin are you planning for in realizing in a network deployment? And then layer across all of those factors the complexity of the other levers that impact labor on a telecom network deployment, whether it's geographic location. So different metro regions have different challenges with deploying, with availability of labor, cost of labor, ability to successfully deploy networks. Population density, another factor. There's obvious and major differences in rural versus suburban or urban deployments. Terrain is huge, of course, when deploying fiber. If you're going underground, rocky terrain, difficult to traverse terrain on an aerial or underground build can significantly impact those levers, whether it's the resources you need to deploy, your efficiency on the project. Another factor relative to that is conditions and timing. If you're deploying in a cold weather climate or conversely a really hot weather climate, that also will impact resourcing consideration, how the project's managed, efficiency, expectations as well. And then as I alluded to before, just purely the type of deployment. Can you do an aerial deployment, overlash an existing infrastructure? Is it a truly greenfield build? Do you have to go underground and to what degree? And so all of this to say, there's a lot of labor-related cost factors and complexity factors that make it really challenging to compete and win and be successful on these types of projects. So when we think about optimizing, it often comes down to, like I said, price and efficiency, kind of the two pillars. So how do we think about price in the context of a fiber network deployment so that we can optimize it? There's kind of two big picture metrics that are looked at most commonly when we think of kind of top level economics of fiber deployment. It's typically either a per household passed or typically per passing price or per route mile deployment costs, whether that's for a route mile of aerial or underground fiber. You can obviously back that down to a per foot estimate, which is common as well. And so this is kind of the building block or the anchor point of when we say, how do you optimize for competitiveness? What are you optimizing for? It's how competitive can you be in a cost per passing or a cost per route mile. The overall average cost per passing for fiber deployment, public sources say between $1,000 to $1,250. That there's a huge range and a lot of variability around that. So if you think of complex rural deployments in Alaska, Fierce Telecom and others have cited figures that can be as high as in the hundreds of thousands per passing, whereas others like Comcast and Altice USA have said can be under 1,000. So again, something to consider as you start thinking about competitiveness is how can you benchmark and get reliable data on accepted cost per passing for different scenarios. Think of the vectors I showed on the previous slide of build scenarios around what's a complex typical project, what are the conditions, what's the timing of year, what's the regions that are involved, and then figure out what's in a market accepted range. Same goes for benchmarking on a per route mile basis. It's about understanding that what we have on the slide here is kind of like industry thumbs in the winds of here's a benchmark, but competitiveness and optimization really comes down to thinking about this at a very granular level of kind of applying the Pareto rule and saying 80% of our deployments are going to look like XYZ in XYZ regions and require XYZ and be done in XYZ timeframe. How do we understand what the industry accepted and customer accepted price levels are for all those scenario permutations, so we can make sure that we can meet that while preserving our margin, and then think about how we meet that, whether it's through our levers of resourcing, efficiency, labor rates, or a combination of all of the above. There's another element to that that makes that a challenge, which is how pricing models are typically structured for these projects. So it would be, if you're just purely billing for resources and you have to add more people to a fiber deployment project and you can bill them directly along to the customer, that's one scenario, and that simplifies, but that's typically, in most cases, not how things are structured. So when business case development happens, as I was just speaking to, it's focused on a cost per passing and what's competitive there, and what are the levers and vectors that are pulled to get to that point of competitiveness. When it comes to actual pricing models and a construction firm or an engineering firm, pricing to the operator, or pricing, if you're a tier 2, tier 3, pricing to the prime contractor, oftentimes it's based on task-based fixed pricing with allowable deviances for change orders. But often the tier 1 EPCs are working under conditions where it's a master service agreement type structure with a catalog of agreed to pricing for different tasks. So provide an example here straight from the 10K of a tier 1 EPC, a known major player in the space that says our agreements include discrete pricing for individual tasks. So for example, if they're going to do a foot of directional boring, there's a fixed price and a fixed measure for that. Same with if they're going to do a certain amount or type of splices, there's a fixed measure, a fixed set of conditions for that. And so with this comes, again, another challenge in terms of those levers it mentions, which is, or I mentioned rather, which is resourcing, labor rates, those vectors. So it's not as simple as resource costs are increasing, and so we can just build the cost of those resources. We can go get those resources with higher wage rates, and then we can pass them along to the operator, to the customers, and higher pricing. It's more, there's fixed benchmarks on activities and tasks, and the supplier of the deployment services, whether it's that tier 1 EPC or downstream, has to meet that price, be competitive, but also ensure that they support their own business case by being more efficient in delivery, finding resources at a wage rate point that supports their business case, and so forth. So this is another overlay of complexity, is the factor that pricing models are often fixed or task-based, not in every situation, certainly. And there are, of course, allowable deviances for things that are in the field, and change orders are common. But again, it just emphasizes the idea that you have to focus on those levers to be able to be competitive from a commercial standpoint. So kind of summarizing some of that and pivoting the conversation to what do you do about it? Like we said, labor can be up to 80% of a deployment project. There's labor shortages, competition for supply that's driving price challenges, price increases across the industry. But whether if you're the vendor that's sourcing that labor can pass on those price challenges is often a stickier question. Deployment effort is highly variable. We talked about all those factors that can influence a deployment, but as we were just saying, on the flip side, it's often fixed price. So it really becomes about doing the diligence and setting market-accepted competitive pricing and optimizing your delivery strategy based on the nature of the project or projects that you have. Wages, there's some wage inflation for qualified labor. It's kind of a back and forth conversation as to whether there really is wage inflation happening in the industry. Certainly seeing some, hearing of some. So while wages are increasing, particularly if there are supply shortages, you need to go out and get qualified labor. Wage increases are a vector for that. The challenge is that, again, pricing isn't so neatly tied out to the cost in the pricing of that labor. And so it's not that one-to-one. And then lastly, in this market, there's a lot of obviously a huge network of national, local, regional contractors that all orchestrate these deployments down to the municipal level. There's overlap in who works with who and what contractors are on what jobs. And so, again, with labor shortages, a lot of the challenges can be about how can you navigate the quagmire of the supplier ecosystem to make sure that you have highly qualified suppliers on projects. We did a whole project recently that was all about the mechanisms used to govern subcontractors to manage rewards and incentives, but also penalize subcontractors. And the root of that effort was really to make sure that they're as optimized as possible, this particular company, in sourcing subcontractor labor, making sure they could find, train, or onboard and execute work with that labor to be competitive. And that's kind of the bottom line is in this market situation where there's lots of opportunity but lots of challenge on the flip side is how do you differentiate and position yourself to win? And I think for us, speaking from, of course, our experience, it comes down to how granular you can get on your understanding of the market opportunity that you're pursuing. So there's two elements to that. One is taking a look at the market from the top down, and the other is optimizing your bidding efforts from the bottom up. And there's a couple elements to that, or lots of elements to that, I should say. Top down, it's about choosing bets and identifying opportunity. So what could that look like? I think most on the call, most that interact with research know that. It's about understanding forecast CapEx, OpEx. What does that look like by market, sub-market, service segment, type of operator, down at the individual operator level? What's their current footprint of rollout and planned footprint of rollout? Who's it going to today and why? What's the share by operator of that opportunity? What's attach rates? That kind of top-down business picture insight. You can understand, say, AT&T's CapEx, OpEx, AT&T's plans on fiber deployment. So I know their homes passed and many others is publicly stated. What's the evolution of that? Are they pulling back? Why, where, how? Who do they use and why? that can help figure out overall pursuit opportunity of where you should be placing your bets, where you should be looking for resources, where you're going from a project bidding perspective. Then once you get there, it's about identifying gaps and opportunities from the bottom up, whether it's in composing a bid or actually executing the work, building a strategy. There's two pillars to that we time and time again are asked to investigate and go deep on as a research firm. It's all relative to exactly what we've talked about throughout this conversation today around pricing and around delivery efficiency. So from a pricing perspective, what are the rates? What are the prevailing rates down at a fine grain level for an individual deal type in a particular municipality for our biggest 5 to 7 competitors? How does that map back to a total cost per activity? What's the prevailing cost for this type of splicing activity in the southwestern United States for XYZ type of project in a 2023 to 2025 rollout horizon? How is discounting happening on deals? What are target margins? How are roles loaded onto projects? What are the pricing models used? So understanding the commercial strategy and the prevailing price levels, as I talked about previously, to figure out, are you competitive today? Are you gapped? If gapped, where and why? And then building hypotheses on how you might remediate that to improve win rate on projects. That goes for whether you're the prime that's contracting directly with an AT&T, Verizon, et cetera of the world, or it goes for if you're a subcontractor that's looking to win business from a tier one that's contracting with those companies. Same is true on the delivery side. And I think in particular, we find, and certainly in the fiber deployment space, when we've done this work in the past, we've seen that labor rates typically within a band of 5 or 10%, pretty competitive across the ecosystem. Where differentiation comes into play is really around delivery capabilities. There's a lot of elements to that too. We talked about some, whether it's the resources and how they load them on projects, what's their bench look like, how do they manage subcontractors, how much can they use subcontractors, how effective are they at delivering with subcontractors, how do they project manage that carry, how effective are they at it, more and more, are they successfully using delivery tools, assets, processes, automation? Depends on a fine-grained task level, what that looks like. Like you could go deep into, just this morning reading an article on in-cassette fiber splicing and how that can take the time of a splicing effort and cut it by 50%. Look at that across the constellation of the hundreds of different activities associated with the deployment and the hundreds and hundreds of sub-activities. Are you being effective? Are you using the right tools, assets, approaches, methodologies? And if not, where are you gapped? How might you remediate? And then also understanding from a reverse perspective, what is the operator that you're working with or the prime contractor that you're working on behalf of expect across all of those elements. So what does that look like? The vendors that we go on this journey with, it's often an iterative process where they have a project or a series of projects where they're trying to understand, are we competitive? Are there opportunities to improve our win rate? Where are we not optimized that we should be looking at optimizing? And then once that's set, it's translating into, I think one of the hardest parts of this process is taking something that's complex and multifaceted and hard to pin down and making it very granular. So for example, you might say, how do we benchmark how many hours it's taking us do horizontal directional drilling in rural areas versus our competitors? That's a big question with a lot of vectors. So it's about how do you break that down into, so really 80% of our business is in this geography and in these metro areas. And we really only see these three competitors. And it's really, we believe we're uncompetitive on these two scenarios. And then you can start to build a true structure around if we had answers to this and could better understand where we were gapped and why, then we could come up with a strategy, define a methodology, implement a new set of tools, onboard new subcontractors to resolve those. And then typically it's no surprise coming from us, a lot of research, data collection, analysis to go out and understand that. Talking to customers, talking to partners, suppliers, subcontractors in the field to understand what's working and not, with whom, what's the demand shape for those kind of activities, what's the expectation, to use my example, around the cost of a foot of drilling and the expectation for how fast that project can move and how many people are deployed on it. It all requires getting into the market, understanding the perspective, capturing information across a structured set of desired outcomes, and then repeating, making decisions, iterating. So I think when we say optimize, it's easy for us to say, of course, but because these projects are so large, multifaceted, competitive in nature, hard to differentiate on a lot of these activities. They're close to the ground, field labor activities, using common suppliers, getting granular and differentiating on understanding the market through data is the way that we've seen companies make entire decisions on entering versus exiting elements of a fiber deployment business based on this kind of data and what pricing the market will bear and whether they feel that they can truly attract and retrain resources or attract and retrain suppliers. And so that's our advice. Our recommendation is to dig into, to think of the business as those pillars that I mentioned, those levers, and then all the sub-levers underneath those, and be continually looking at ways to dial and optimize those. And so just a quick note, we did put together a paper that goes much deeper on this topic, gives more examples, pulls forward more data and trends from our relevant research on this topic. So do feel free to check that out. The link will be in the webinar console if you're interested. And of course, we invite any and all questions and any and all conversation. Happy to go deeper, pull data that we have as well. Speaking of questions, with that, we'll open the floor to questions. We do have a few that have popped up. This one says, do you see gaps here impacting the rollout and deployment of Open RAN and 5G today? Will it potentially be a problem once operators execute? I think a lot of, if we talk the gaps we're talking about here, which are largely around shortage of labor, those pricing factors, efficiency, we've done an equal number of efforts tackling those challenges for the 5G side as we have the fiber deployment side. I think fiber deployment is top of mind, just given the funding that's going in that direction, given how much of core kind of field labor is required. And then, but I think the same as dynamics are true, certainly around 5G deployments. Open RAN, I think, is a separate conversation, and one that I would advise is probably a better conversation for our group in telecom that's covering that market. Certainly, I think there are, in the projects we've done, there's a suggestion, indication that the shift to that environment is going to bring down costs and support efficiencies. as the guy that goes deep on projects in this area, we just haven't touched on it. Folks haven't been there yet from a project perspective, so I can't speak to kind of granularly from a point of view of these levers what we see. So another, I think, question or topic that's come up quite a bit lately is, I think our point of view on this space is rooted in a perspective of there's a long-term, or I should say medium-term, major market opportunity here that requires navigation, given the government funding that's going to this space. And I think you read some of the articles out there, there's a little bit of pushback of, well, isn't it actually going slower? Fiber deployments are going slower than expected, and there's a pullback happening. And so how do you reconcile the idea of this opportunity with a pullback? And so I think our answer on that would be, and I think others have said this as well, so the pullback typically refers to, there's a lot of the carriers have reduced their guidance on number of passings, a number of homes passed for 2023. I know examples, AT&T, Frontier have dropped from anywhere from 1 million to 500,000 or so. Altice and Lumen and others. I think it's more of a reset. I think when you look at, and I know like Fiber Broadband Association and CEO of Frontier and others have said similarly that it's more of a reset and a rethink around a lot of the dimensions I talked about here today, around how do we most effectively align resources, what are the methodologies we need to have to be competitive. I think long-term trajectory, if you look at the numbers on kind of aggregate estimates of total passings, I think there's still a lot of significant positive momentum around where the deployments are going long term. So it's a little bit of, I'd say, a reset for the very reasons of looking at the topics we've been covering today, not a wholesale kind of rethink or moving away from the bullishness around deployment of fiber. And then another, I guess, last question that just came in is, what group or groups of vendors is best positioned to capitalize given this dynamic of opportunity but challenge, and why? Maybe a bit of a cop-out answer, but I guess we don't see a lot of major difference in the value chain of vendors doing this work. I think where, and what I mean by that, like tier one EPCs driving the business with subcontractors at a regional and sub-regional level supporting that. I think it's more about who's going to really win, isn't going to win on undercutting on labor rates, or it's going to be whoever can get the deepest differentiation around delivery efficiency, whether it's deploying or developing a new set of methodologies, just being more effective at executing on those methodologies. That's typically when we do this work. Like I said, it's very rarely this company is winning by charging a set of price points that are allowing them to win volume at a significant rate versus peers. It's much more, this company either has the resources to support the project, or this company has a methodology for trenching or a methodology for splicing that's allowing us to be much more effective and successful in both quality and speed of deployment. And that obviously has a downstream impact on their ability to then compete on pricing as well, or to retain successful delivery as margin. And so, like anything else in this market, I think it's going to come down to who is most aggressive about getting to that spot. And then I guess another question that's come in last question that's come in is, do you see any further change or evolution in pricing models in response to some of these trends? I think we've done this work consistently for a decade, and there's been just a continual march toward kind of more fixed or more like that task-based structure. I think where there's going to be more evolution, and where everybody does it a little bit differently, is in how commercial models are managed downstream. So what do I mean by that? So if Telecom or an EPC has a task-based catalog set with AT&T to go out and do this work, how do they structure that commercial model downstream to their subcontractors, whether it's with their larger subcontractors, the subcontractors that support those subcontractors, or both. And so there's different models to managing and monetizing or paying subcontractors, whether it's, again, a T&M structure, or are you using the same task-based structure? What's included in the scope of the subcontractor workflow? That's something where I think those relationships and models have to evolve. There's other things happening there too around sourcing. Vendors exploring, do we source this labor through more of a, instead of giving a region to a subcontractor, or an entire project or scope of sites to a subcontractor, how do we be more modular and adopt the elements of crowdsourcing models? And so I think that pricing structure, if you're just thinking about how does an AT&T pay a Telecom, is going to stay pretty consistent. It's more, how do the vendors that are contracting primarily with the operators structuring commercial models that support them being most successful with their subcontractors?